Supermax Corp's share price took a substantial hit today after it was reported that the U.S. Customs and Border Protection had moved to ban imports of its gloves over forced labour allegations. Supermax was among Bursa Malaysia's top losers for the day as the stock closed 9% down at RM2.05. During the day, it had plunged by as much as 11% or 25 cent to trade around the RM2 mark. It was also the third most actively traded stock on the bourse as volume spiked to a 5-month high, with over 78 million shares changing hands. Analysts say the CBP's decision to slap a withhold release order against Supermax and its subsidiaries is expected to have a significant impact on its earnings. CAF research analyst Nabil Zainuddin told The Edge that the US historically contributes around 20 to 30% of Supermax's earnings and that the gloves command premium pricing stateside compared with other countries. According to him, the impact also depends on how long it takes for Supermax to resolve the issue, pointing out that it took competitor Top Glove Corp almost a year. Nabil also points out that Supermax's expansion plan is still ongoing in a big way, with 5 glove manufacturing plants under construction. Another analyst says that the WRO may reduce the company's earnings by 15% for FY22, but that if Supermax decides to dump gloves like what Top Glove did when faced with the same situation, the earnings impact may be less. The analyst says that it is likely that Supermax will immediately hire an auditor to go through the audit process and assess the damage. To recap, in a press release, the CBP said that all gloves from Supermax and its subsidiaries will be detained at all US ports effective October 21st. CBP Office of Trade Executive Assistant Commissioner Anne-Marie Highsmith says that with 10 of the 11 forced labour indicators identified during the course of its investigation, the organisation has sufficient evidence to conclude that Supermax produces gloves in violation of US trade law. She adds that until the group can prove their manufacturing processes are free of forced labour, their goods are not welcome here. Supermax joins the list of other Malaysian companies banned by the CBP, which include Top Glove, FGB Holdings and Sime Darby Plantation. DG.com saw its third quarter net profit dip 2.5% to 312.8 million, despite top-line holding steady as the telco registered, among others, higher depreciation and amortization for its assets, besides a net loss on foreign exchange and fair value movement of foreign currency forward contracts. Revenue stayed flat, improving 0.3% to 1.58 billion, as postpaid service revenue strengthened to 633 million, the highest in 5 quarters. DG's postpaid service subscribers rose to 3.25 million from 3.02 million, which the telco said reflected its strategic efforts to drive data monetization, as well as delivering sustainable subscriber and revenue mix. DG also declared a tax-exempt dividend of 4 cents per share. Looking ahead, DG says it will continue to execute its strategy of strengthening mobile offerings and digital services for subscribers to benefit from growing digital opportunities. As the operating and retail environment gradually returns to normal, DG says it is revising, among others, its FY21 guidance to a low single-digit decline for service revenue and low to mid-single-digit decline for EBITDA. DG also clarified that the proposed merger between Celcom Axiata and Digi Telecommunications is progressing as planned, and the expected dates for approval and completion of the transaction within the second quarter of 22 remains unchanged. IGB's indirect wholly owned subsidiary Veroki has sold its 50% stake in property investment firm Black Pearl to HNG Blackfriars One for £104.4 million UK. In a statement to the bourse, IGB says Veroki and Tower Ray, which each own a 50% stake in Black Pearl, have entered into a sale and purchase agreement with HNG and Veroki's holding company IGB Corp to sell their entire holdings for a collective £208.75 million. Black Pearl owns the freehold title to the land known as 18 Blackfriars Road, SE1 London in the UK. IGB says its directors consider the transaction as beneficial to the group and represents an opportunity to realise its investment in Black Pearl. The company says the proceeds will be used for general working capital, including but not limited to redeploying capital for more value accretive investments. According to IGB, the original cost of Veroki's investment was £5,000 for the 50% equity interest in Black Pearl. As at the last consolidated audited financial statements of IGB as at December 31st, 2020, the carrying amount of Veroki's investment in Black Pearl was 370 million ringgit, which included shareholders' advances to Black Pearl of 376.5 million ringgit. Lotte Chemical Titan Holding has decided to proceed with the construction of an 18 billion integrated petrochemical project in Indonesia in view of the increase in COVID-19 vaccinations worldwide and opening up of global economies. The construction of the Lotte Chemical Indonesia new ethylene project is expected to commence in 2022 and be completed by 2025. Lotte had previously said that the project will double its existing production capacity as well as propel it into the top 3 companies in Southeast Asia alongside Thailand-based Siam Cement Group and PTT Global Chemical. Initially, the group expected to commence construction at the end of 2020 or early 2021, only to have it derailed by the pandemic. The Real Estate and Housing Developers Association Malaysia said that the local property market saw a 8% decline in new launches and 6% in sales performance in the first half, according to its property industry survey for the first half of 2021. When presenting the results of the survey, REDA President Datuk Suam Heng Chun says that the market's performance was unusually low, as developers were expecting the market to recover from the lockdowns in 2020, but only 39% of 4,524 units were sold out of the 11,601 units launched. This was lower than in the second half of 2020, where 45% of the 12,640 units launched were sold. In the surveyed period of the first half, only 35% of respondents managed to launch their projects. Residential properties dominated, making up 98.5% of new launches, with commercial properties at only 1.5%. On a brighter note, Malaysian developers showed increased optimism about the outlook for the property industry and economic environment in the first half of 2022. When asked whether the property market had finally bottomed, Soam points out that the performance of the primary market property sales under the home ownership campaign in fact improved in 2020 despite the COVID-19 pandemic when compared with 2019.